so we will be talking about Chapter 13, which is the cost of capital. So, talking about the firm's overall cost of capital. So, unique risk is a risk that can be eliminated by holding a diverse portfolio. So, that means that systematic risk is the only risk that investors require compensation for bearing. So, examples of systematic risk, basically things that you can't really control as a company. So, government changes a business law. You didn't necessarily, I mean, you may have voted on it, but that's all you can do. Also, like, let's say an earthquake destroys Silicon Valley, that's going to destroy the tech economy for a certain period of time. So those are two examples of systematic risk. So you rely on CAPM, the equation that you guys just talked about, to arrive at the expected rate of return for an investment. So what practical concerns can make the the reliance on CAPM arriving at an expected rate of return for investment difficult to implement? We've got your back. We will explain. So firms do not issue publicly traded shares for individual projects. So that means that firms can't estimate the discount rate that reflects the risk of the incremental cash flows from a project that they do. So how do the financial managers of a firm solve the problem? Well, one, they can estimate the cost of capital for the firm as a whole. So instead of for each individual project, you can just do it as a whole for the firm, and then requiring analysts within the firm to use the formally stated cost of capital for the firm as a whole to discount the cash flows for all projects. So just doing it as a whole instead of individually. But the problem with this is that this ignores that a firm is a collection of projects with varying different levels of risk. So that means that they would just assume one risk for the firm, which isn't really realistic. So the accounting balance sheet, and this is just an example of, it's been a while, like it has been for me since I've taken accounting. Accounting balance sheets reflect book values. So on the left-hand side, where you see like the assets, that's where you have the book value of the firm's assets based on historical costs, and on the right-hand side you'll have how the assets were financed. Now this varies from the finance balance sheet, because the finance balance sheet on the left side reflects market values, not book values of the assets. So that's how the finance one would be different. And they present the total cash flows that those assets are expected to generate in the future, not based on historical values, unlike the accounting balance sheet. And the claims that investors hold are supposed to equal the cash flows that they have a right to receive, and as well as the total market value of the debt and equity of a firm is also the present value of the cash flows that the debt holders and the stockholders have the right to receive. So it's much more about the stockholders and the debt holders and the people involved in the financing of the company in this case. And here's an equation that will be important. So this is market value of assets. So the market value of assets equals the market values of liabilities plus the market value of equity. It's not really a mathematical equation, it's just more of a concept. And here's just a little chart to illustrate what is contained within the finance balance sheet. So you have the market value of the firm's assets on the left side, and again, not the book value because this is the finance balance sheet, and then the market value of the claims on the firm's assets on the right. So estimating the cost of capital, you have to estimate the betas for each individual project, and you can estimate the beta for the entire firm as a weighted average of the individual betas. So again, you're doing it for the entire firm, but you have to take into account each individual project. So you use finance balance sheet and the concept of market efficiency to estimate the cost of capital for the firm. The analysts for the firm won't perform calculations for the individual projects on the left-hand side of the balance sheet, but they will perform a similar set of calculations like that for the different types of financing for debt and equity on the right-hand side of the balance sheet. And so the cost of capital, as long as they can estimate the cost of each type of financing by observing that cost in the capital markets, They can compute the cost of capital for the firm using this equation. So that would be the cost of capital for the firm. And again, it's the sum of all the individual, basically, projects that the firm does. And again, another equation for the cost of capital for a firm. If you divide the cost of capital into debt and equity, then you can use that to arrive at the weighted average, the WACC for a firm with only the debt and equity. So again, a little bit simpler. And here's the example of weighted average cost of capital. The total value of the firm is $4 million, and it has $300,000 of debt. The cost of the debt is 6%, and the cost of equity is 10%. What is the weighted average cost of capital? And again, you would plug it into that formula that we just had, and you would arrive at 9.7%. Again, it'll give you the decimal, but of course you have to change that into the percentage. And so here's from the homework. Again, this is, you're using one of the formulas. Basically, the common stock, Cerex Watt Company, is expected to pay a dividend of $1.10 1 year from today on its common shares. So you would plug that into the D1, 110, and then the dividend is expected to increase by 5% every year thereafter. If the price of Cerex common stock is 13.75, what is the cost of its common equity capital? So the common stock, the price of the common stock, 13.75, you put that on the bottom, and then the 5%, you would change it into a decimal, add that, and then you would come up with 13%. And then the other homework question from this section, Ford Luxury Liners has preferred shares outstanding that pay an annual dividend of $15 per year. Current price per preferred shares is $107.14. And what is the after-tax cost of preferred stock for Ford? Very similar. You would just plug the 15 into the top, 107.14 to the bottom, and you come up with 14%. So estimating cost of debt, you often can't directly observe the rate of return that investors require for a certain type of financing, but instead you have to rely on the security prices to estimate the required rate. So for costs associated with each type of debt, when calculating capital for a firm, you use the cost of the long-term debt. So the long-term debt is basically debt that is set to mature in more than 1 year. It's also called permanent debt because firms will often borrow the money to pay off this debt once it matures in over a year. And the interest rates on outstanding debt does not necessarily reflect the current cost of debt. So the current cost of long-term debt is the appropriate cost of debt for WACC calculations. So that's what you would use. WACC is the current opportunity minus the cost of capital for a firm's investors. And so you would use the yield to maturity, the YTM, for a cost of debt, and adjust for tax deductibility of interest on debt. And now Vinny will fill in for me.
Next here we have taxes and the cost of the debt equation. The after-tax cost of interest payments equals the pre-tax cost times 1 minus the tax rate. So here's our example. You can see in the parentheses we have the 1 minus the t, which is your tax rate. Another example for you here. The before tax cost of debt for a firm is 6% and the marginal tax rate is 20%. What is the after-tax cost of debt for the firm? We have our 6% multiply the 1 minus the rate, just the 20% there, leaves us at 0.048 or 4.8%. Estimating the cost of debt. Current cost of debt for a publicly traded bond is derived from its yield to maturity calculation. Consider compounding periods in effective annual interest rates and the cost of issuing a bond, so float costs. For private debt, a firm can ask their bank and ask what rate the bank would charge if they decided to refinance the debt today. To To estimate the firm's overall cost of debt when it has several debt issues outstanding, we must first estimate the cost of the individual debt issues, then calculate a weighted average of these costs. Come up to the cost of equity and common stock. Just as information about market rates of return is used to estimate the cost of debt, market information is also used to estimate the cost of equity. There are several ways to do this. The most appropriate will depend on what information is available and how reliable the analyst believes it is. So we have three methods below here. First one, CAPM there. Method 2 using the constant growth dividend model, and method 3 using a multi-stage growth dividend model. Capital asset pricing model, so CAPM again. The first method for estimating the cost of common equity is the CAPM method. Do you want to explain that? Yep, we had our equation there. Perfect. There are some practical considerations that must be considered when choosing the appropriate risk-free rate, beta, and the market risk premium for the above calculation. The recommended risk-free rate to use is the risk-free rate on a long-term treasury security, because the equity claim is a long-term claim on the firm's cash flows. Long-term risk-free rate better reflects long-term inflation expectations and the cost of getting investors to part with their money for a long period of time rather than a short-term rate. One can estimate the beta for that stock using a regression analysis. Identifying the appropriate beta is much more complicated if the common stock is not publicly traded. This problem may be overcome by identifying a comparable company with publicly traded stock that is in the same business and that has a similar amount of debt. So you could always just look for another company as an alternative that's public, of course. When a good comparable company cannot be identified, it is sometimes possible to use an average of the betas for the public firms in the same industry. So you can kind of look around the industry as well. It's not possible to directly observe the market risk premium since we don't know what the rate of return investors expect for the market portfolio. For this reason, financial analysts generally use a measure of the average risk premium investors have actually earned in the past as an indication of the risk premium they might require today. So it shows from 1926 through the end of 2015, actual returns on the U.S. stock market exceeding actual returns on long-term U.S. government bonds by the average of 5.92% per year. Constant growth dividend model equations. So the first one on this page. In the second method, though, to estimate the cost of equity, we use the constant growth valuation model we discussed in Chapter 9. And then below, another example, we can rearrange the equation to solve for the required rate of return if we don't have that. In order to solve for the cost of common stock, we must estimate the dividend that stockholders will receive next period, 1, as well as the rate at which the market expects dividends to grow over the long run, which is G. This approach is useful for a firm that pays dividends that will grow at a constant rate, which is appropriate for an electric utility, but not for a fast-growing high-tech firm. And already through the multi-stage growth dividend model, the third approach is based upon the supernormal growth dividend model discussed in Chapter 9 as well. The complexity of this approach lies in choosing the correct number of stages of forecasted growth, as well as how long each stage will last. Because of the algebraic complexity in solving for the required rate of return, the value is generally solved through using a trial and error method after forecasting the different stages of dividend growth. And here's our example of this here. So you can see long-term setup. Okay, we'll take it from here.
All right, for common stock, which method should we use? In practice, most people use the CAPM method to estimate the cost of equity if the result is going to be using the discount rate for evaluating projects. The characteristics of preferred stock allow us to use the perpetuity model to estimate the cost of preferred equity. Just as with common stock, we can find the cost of preferred equity by rearranging the pricing equation for preferred shares, like so. There's an example here. A share of preferred stock is a 5% dividend rate, 100% stated value, and a price of 85. What is the cost of this preferred stock? So we set the equation with the $100 times 5% equals 5. And then we rearrange the equation here, 5 divided by 85, and we get 0.0588 or 5.88%. Then we can use that weighted average cost of capital. The average tax, the after-tax version of the formula for the weighted average cost of capital is right here, debt pre-tax, 1 minus T, etc. It should be noted that the financial analyst should use market values rather than book values to calculate the WACC, using WACC methods. Limitations of the WACC as a discount rate for the value of projects are, financial theory tells us that the rate that should be used to discount these incremental cash flows is the rate that reflects systemic risk. This means that the WACC is going to be the appropriate discount rate for evaluating a project only when the project has cash flows with systemic risks that are exactly the same as those for the firm as a whole. When a single rate such as the WACC is used to discount cash flows for products or projects with varying levels of risk, the discount rate will be too low, in some cases too high in others. When the discount rate is too low, the firm runs the risk of accepting a negative NPV project. Estimated NPV will be positive even though the true NPV is negative. When the discount rate is too high, the firm runs the risk of rejecting a positive NPV project. Estimated NPV will be negative even though the true NPV is positive. The key point is that it is only really correct to use a firm's WACC to discount the cash flows for a project if the following conditions hold. Condition 1 is a firm's WACC should be used to evaluate the cash flows for a new project only if the systemic risk for that project is the same as that of the portfolio of projects that currently comprise the firm. And condition 2 is a firm's WACC should be used to evaluate a project only if that project uses the same financing mix, the same proportions of debt, preferred shares, and common shares used to finance the firm as a whole. And this is an example of potential errors you can have when using that to evaluate projects. And there are alternatives. If the discount rate for a project cannot be estimated directly, a financial analyst might try to find a public firm that is in a business that is similar to the project. This company would be what a financial analyst call a pure play comparable because it is exactly like the project. This approach is generally not feasible due to the difficulty of finding a public firm that is only in the business represented by the project. Financial managers sometimes classify projects into categories based on their systemic risks. They then specify a discount rate that is to be used to discount the cash flows for all projects within each category. And this is an example of potential errors you can have when using multiple discount rates. And we have the homework problem here of 13.7, cost of common stock. So two-stage rocket paid an annual dividend of 1.25 yesterday, and it is only known that the firm's management, and it's commonly known that the firm's management expects it to increase its dividend by 8% for the next 2 years and by 2% thereafter. The current price of two stages common stock is $17.80. What is the cost of common equity capital for the firm? And we have these equations set up like this. This is how we're supposed to set it up here, and then plug all the numbers in. There we go. Cost is 10%. That's it.
Alright, our chapter is on how firms raise capital. We're going to kind of go through this pretty quickly, but everything that you need to know will be highlighted. We'll try and stop, and then we'll get to the problems at the end so you guys can see the problems and how to do them. So when you first start a new business, it's called bootstrapping. When you pull your boots on, pull them up by the straps, and you kind of work hard. That's why it's called bootstrapping. You kind of flesh out your ideas, and you make your first business, and you start your first business plan with like usually your friends or someone you trust.
And then the initial funding of the firm, it's called the initial seed, where basically it comes from entrepreneurs or other investors, and it also could come from any type of savings, assets, or any type of loan. In most cases, it's spent on developing the product or service based on the business plan.
Usually lasts 1 or 2 years. This is like a step-by-step process for how to start a new business. Usually bootstrapping period lasts 1 or 2 years.
Okay, and then venture capital. It's important because entrepreneurs only have limited access to funding, and there's a high risk towards the venture capitalism. And types of product assets, it's patents and trade secrets and information asymmetry problems. An entrepreneur knows more about his or her company prospects than the lender does.
So this is the step-by-step process that you're going to follow if you make a new business. You're going to be like, okay, cool, I have a new business idea. You're going to start with your buddies, your friends, people you trust, people that you work with. Then you're going to come up with a business plan. Then first stage of financing is that bootstrapping process. You're going to pull yourself up and pay for it and pony up some of your own money. Or maybe you have a friend that has some money that wants to get involved. And then after that, you're going to reduce your risk by funding in stages, which will be the next slide. You guys get to see that. This is followed by getting an angel investor, a venture capitalist to come and fund your business. And then usually they end up selling a percentage of what they bought or put in your business to other venture capitalists, which negates their risk or lowers their risk a little bit. And then you're going to continue to research and grow your business, and then eventually you have to have an exit strategy, especially as a venture capitalist, because at some point you need to get out of that business or stay in that business. That's where you need to do your research. And this is this stages. So bootstrapping, seed is where you get somebody that you know, that you trust, an entrepreneur usually. Early stage financing is that first venture capitalist. Later is the next set of venture capitalists, and then you take it to like an IPO.
All right. For initial public offering, the advantages is that it's a typically larger amount that can be raised through private resources or investors, and it can enable an entrepreneur to fund a growing business, also investments. And after the IPO, there's a secondary market where people can sell and buy shares.
It costs a lot to have an IPO or to go fund an IPO, but it's a lot safer because you're going to deal with the SEC, but part of dealing with the SEC is you have to pay to be protected, and the requirements that you have to disclose a lot of the information because you're now a publicly traded company. So usually only big companies or companies that funded a lot of money end up doing this. Underwriting is what we just kind of went over last class. It's being able to understand how much money you're willing to put in to pay for a business and how much that business is worth. All right, private versus public markets. Private markets are typically smaller. Public markets are typically bigger. There's a lot more money in public markets, but it's also a lot slower because of the SEC. The private markets are a lot quicker, a lot faster paced. You're not subject to the what we consider the stock exchange times. What was that, 9 to 4, whatever it is in the afternoon? Those times you can do it over dinner, and that's what a private market is. You're not. But it's also a little bit scarier for both ends because you can get cheated out of a lot of money because there's no SEC protecting you.
And And private equity firms, they pool money from any type of investor or company and put it back into the business. And private equity firm managers try to increase the value of the company to get a return.
You guys can pull up the PowerPoint, but we're trying to get to the problems at the end for you guys.
Do you want to do
That the loan pricing model, this is how the bank determines the interest rate to charge on a loan. So it takes the prime rate, which is the same for everybody, and then adds the adjustment for the default risk. This is like your credit score. They take into a bunch of factors to calculate the DRP, and then they adjust with the yield curve and what the market is set at. This is problem 15.8. Tradex Incorporated. It's a high-tech firm in Portland, and it raised a total of $90 million in an IPO. The company received $27 and $30 per share offering price. The firm's legal fees, SEC registration fees, and other out-of-pocket costs were $450,000. The firm's stock price increased 17% on the first day of trading. What was the total cost to the firm of issuing the securities? So you're going to do the underwriting spread, and calculate how much money per share was made, and then you just calculate the cost, and that where you get that $9 million. The out-of-pocket costs were already given to us in the problem, and you calculate the stock price at the end of the day. So it started at 30 plus 1 plus 0.17. That's how you get the 1.17. That's how much it was worth at the end of the day. How much is it underpriced to start? It was 510 because that's 35.10 minus 30, so you get $5.10. Total underpricing, you get that by how many shares there were, and then from there you calculate the total cost of selling the IPO, and then you get $24,750,000. You gonna leave it up there? Everybody good? We can go on the next one, or good?
Yeah.
Cool.
All right. So the problem is private placement versus public debt offering. And Nalco Holding is an international company that operates in 130 countries, has a market capitalization of $2.3 billion, and reported net income of $45 million on $3.3 billion in revenues last year. The company needs to raise $200 million in debt, and management is deciding between private placement and public offering. What are the advantages and disadvantages of the two alternatives, and which is likely to be the best choice? So, the public market allows for higher security since SEC is involved and offers more liquidity, which might be important for a larger issue, and most of the times to earn higher yield. And then for the second alternative, private placement, offers faster speed, lower insurance costs, and ease of restructuring. And the company would be better off choosing to raise debt in the public market.
So you got to remember that public is large, safe, and slow, and the private market is small, fast, and risky. If you guys know those three things, public and private, then you're good. You know this. And then one more problem. This is another underwriting and underpricing problem with an IPO. You calculate the underwriting cost again, the spread. So the firm received $2 per share. Number of shares were $120 million worth of shares. You can kind of just follow along down there to the total cost of the firm. Total cost to the firm would be $30,270,000. That goes back to kind of what we did last class with underwriting. So you have to match that and make the net present value or net cost 0. Is there any questions? We went really quick. So.
Sure.
make sense? Anybody else want to give me their submissions, resubmissions, resubmissions? I'll take one. Okay, perfect. I'll take one. Anybody else? Where did we leave off on for the exam? And then do you have your calculators? Anybody need to borrow? Are we doing the REITs?
We finished the game we're on the stock valuation.
Yeah. And is that what are we doing, the check stuff?
It doesn't really.
Yeah, we're doing the established check company valuation. So would you pull out your blue book and your calculators? How much time do we have?
30.
How much?
40.
Great.
40.
I forgot it's at 20. It's time to get your, time to get your pie to it. Before we get into the problem.
Today.
No pies?
Today.
Come on. 2 in 1 day. I can handle it.
Cheat day.
You got your exam?
Yeah.
Got the blue book? Got your calculator? I got some calculators up here. Okay, we're going to do the stock valuation for idea. Okay, I'm going to walk you through the methodology. I'm going to do stock valuation. Now the book basically gives you discrete valuation methods. You know, perpetuity, glory, growth, multiple approach, DCF, but they don't really tie it together to create different rating scenarios and different methodologies to come up with the final intrinsic value. Okay? And that's what we're going to do here. And actually, the approach that we're doing right now is going to be used for the final project at the end of the semester, which is coming up pretty soon. So this methodology I'm going through is directly related to the case study that we're going to do at the end of the semester. Okay? We'll probably start that process as soon as possible after the midterm. We'll start to move into the valuation methods. Okay? All right. So as we know, there are 4 main valuation methods for this case study. We are going to use earnings per share. I'm not using EBITDA per share because I'm not valuing the startup company. We're a newly IPO'd company. So this is an established company. They've been around for a long time. We are the equity analysts, and we are going to conduct an intrinsic valuation using the 4 methodologies with 3 scenarios to come up with the final intrinsic value, to come up with the recommendation and the trading strategies. Okay? All right. So I could be a broker-dealer that does this. I could be an investment advisor. I could be part of an investment bank using this methodology. I could be in a family office valuing securities using this methodology. I could be an individual investor using this methodology. It's the fundamental securities analysis. Okay? So we know the 4 methodologies. Perpetuity, Gordon growth, multiple approach, discounted cash flow. Here are the assumptions: earnings per share growth rates, forward EPS, expected discount rate going in, terminal, pro forma growth rates for the earnings per share, current stock price. They do give you a multiple and a 5-year holding period. Okay. So what's the first methodology?
Perpetuity.
Yeah, perpetuity. calculate the evaluation using the perpetuity approach?
Cash flow,
We need cash flow last year, this year, next year,
for next year.
next year. What do we do with that? And you guys can all jump out and, make this interactive. It's more fun when everybody starts yelling at me.
Put it over the return expectations.
Yeah, the expected return, that's gonna give us the valuation using the perpetuity approach. So do they give us next year's cash flow, or do we have to calculate it? I can calculate it. Why don't we calculate it first, because they do give it to us, but let's calculate it first. So what do we need to calculate next year's earnings per share?
You take this year's
Which is
13
times,
the growth
which is,
rate, which is 5%.
okay, and what's that, $13 times 1.05? Everybody's gotta be doing the calculators. Or you build a spreadsheet and you do the calculations in the spreadsheet.
13.65.
Yeah.
13.65, 13.7. So what do you want to use? 13.7 and 14. They gave us some guidance. I'll leave it up to you to decide which ones you want to use. You're the analyst, you make a decision.
Use a midpoint. 13.85.
That's probably the right thing to do. Use some kind of. So we got 13.85, and do they give us a expected return?
Yeah, going in is 8%.
0.08. And what is the valuation using the perpetuity approach? $173.13.
Yeah.
Thank you. What's the next method? I'm gonna start to,
Gordon growth.
as I start to do these problems, I'm gonna start speeding it up because you guys are getting, a lot of you are getting it. So just that, I don't need to go through a lot of the rudimentary stuff. We can start just pounding the stuff out. Okay, Gordon growth. And how do we calculate the valuation using Gordon growth?
Cash flow,
Last year, this year, next year?
next year.
Divided by,
The return expectations minus the growth rate.
got it. And what's our cash flow for next year?
That's the 13.85.
14.85. And anybody else can talk over him. Usually when you're in a meeting, people talk over each other because they want to show how smart they are. So for others in the class that want to show how smart they are, you can definitely talk over him at any time you want. Okay. Yes, what was your question?
No.
Okay. And then what was the expected return?
8%.
0.08. And then what's our growth rate expectation?
1%.
1%. 0.01, that gives you 0.07. And what's 1385 divided by 0.07?
197.86.
197.86. Got it. What's the next method?
Multiple.
Okay. And what's the equation?
Cash flow next year.
Cash flow next year.
That's the multiple of next year.
Got it. It's going to give us the value of the multiple. These are all T+1s. All these valuations are always for next year. So you're always trying to value the stocks for next year. Okay. And then what's our cash flow for next year?
The 13.85.
13.85. And do they give us a multiple?
15.
Yeah, they gave us 15 times. What I like to do is I like to check the multiples using the perpetuity and the Gordon growth just to get some context. some comparative analysis. So what is 1 divided by 0.08?
12.5.
0.5 times, got it. And then what is 1 divided by 0.08 minus 0.01? That gives us the 0.07. And what's 1 divided by 0.07?
12.49.
12.49 times, got it. So these are on the low side, so it looks like people are willing to pay a higher multiple on the cash flow currently to get the intrinsic value. Okay? And we may have gone ahead and forecasted this. And we may have forecasted this on our own, which is what we probably did. So what's 1385 times 15?
207.75.
207.75? Got it. And give me this one. What's 1385 times 12.5?
173.13.
And what you'll see is the 1 divided by the expected return gives us the multiple. Multiply the multiple by the future earnings per share. You get 173.13. You get the same as the perpetuity. So you can do it 2 ways. Okay. So you got to be willing to switch back and forth sometimes between the two. Okay. And then what is 1249 times? Is that right? 1 divided by 0.07? 12.49. Can you check that number for me?
14.28.
It looked low, because it was too close to this, and that's impossible to have Gordon growth multiple be almost the same as perpetuity. So if you understand the theory, you can check your numbers, okay? And you gotta be constantly checking the numbers. Did everybody understand that? Yeah, so that's how I picked it up. So what was the multiple?
It's about 14.3.
14.3. And what's 14.3 times 1385?
197.86.
What is it?
197.86.
Which is basically the same as the Gordon growth. So usually when I only have a limited number of multiples. I like to see the multiples. These are pretty close, aren't they? This is not like 20 and 10. We seem to cluster, right? Within a relatively tight range. So that means that your valuation is going to be pretty accurate using the multiple approach. Okay, and we're going to use this one. Okay, and we're going to use that. Okay, so we already have 3. And what's the methodology?
Discount.
And what do we need to know? What's the first thing we need to know to do the DCF methodology? What's the first thing I need to know?
Sure.
Set up the structure.
How many years?
Yeah, the holding
The
period.
5-year holding period.
Yeah. And usually the average holding period for a stock, for a retail stock investor is between 5 and 7 years. Okay. So I just use 5 because it's easy. 3, 4, 5. Do I need just 5 or
6.
No.
6? What do we need the 6 year for?
Terminal value.
Got it. TV. Excellent. All right. And what do you want to do first? Cash flows or discount factors?
Cash flows.
Cash flows. Okay. Okay, and then what cash flow do we use for the first year?
1385.
Which one? What is it? 1385. And how do we get year 2? What is it?
Multiplied by the growth rate.
Okay, which is?
1.05.
Got it. And what's 1385 times 1.05?
14.52.
14.52. How do we get year 3?
Multiplied by 1.04.
Got it. And what's 1452 times 1.04? Again, you guys should be calculating this stuff. Do you have a calculator?
15.1.
Maybe use your calculator, huh?
15.1.
Okay. 15.10. Yeah, you should be going through and practicing your calculator steps. Just crank it out. Is that right? 15.10?
Yep.
Okay. Yes? Yes. Well, you were the one that said 15.10. So
Yeah, he said it too.
got it. Awesome. Thank you. And then how do I get year 4?
Times by the next growth rate of 1.03, which
1.03.
gives you 15.55.
15.55. Is that correct?
Yes.
Excellent. And then what do we multiply it by?
1.02,
1.02. And what do we get?
15.86.
86.
Yeah.
And then do we end it there or keep moving?
One more.
One more year. What's the growth rate?
1.01.
1.01. And what's 1586 times 1.01?
16.02.
Is that right?
Yeah.
Yeah. 16.02. Got it. Okay. Now let's do the discount factors. So what's our expected return?
It, going in or term? Going in is 8%.
Got it. Okay. 1.082, 1.083, 1.084, 1.085. What's 1.08 to the 1?
1.08.
1.08. What's 1.08 to the 2? Or
1
squared?
1.17.
What is it?
1.17.
Thank you. What's 1.08 cubed?
126.
0.26. What is 1.08 to the 4th?
1.36.
0.36. What is 1.08 to the 5th?
1.47.
47. Awesome. Whew. That's exhausting. And then what do we do with the year 6 cash flow?
We take the terminal expectations.
Yeah, terminal discount rate or expected return.
Yeah.
The discount rate,
What is it?
10%.
1. What's our terminal growth rate?
1.01.
1. That gives us 0.09. Test question, why do I use a higher discount rate or an expected return than the going in for the terminal? Why do I use a
High risk.
higher risk? Okay, can I predict with 100% certainty what the future of these tech companies' earnings growth rates are going to be in the future?
No.
No. Can I predict the level of competition or intensity of competition will be in the future?
No.
Can I predict economic events and rate of obsolescence and technological advancements? No. Okay. So I have to use a higher discount rate. And basically, those are the same factors I would use to push the growth rates down too. Okay. All of those factors. All right. So what's 16.02 divided by 0.09?
17.8.
What is it?
17.8.
70?
17.
That's not right.
It's 178.
Yeah, that's right. That sounds right. Okay, 178.
0.00.
Got it. Okay, anybody else?
Are you supposed to add 1 to the bottom, so it's 1.09?
No. It's 0.1 minus 0.1 minus 0.01 gives us 0.09. This is 1%. 0.01 is 1%. 0.1 is 10%. 0.1 minus 0.01, 0.09, 1602 divided by 0.09 gives us 178. Is that correct?
Yeah.
Okay. And then what do I do with the terminal value?
Divided by.
Nope. Not yet. What do I do with the terminal value?
You put it over you put it basically next to the year 5.
And what do I do? Do I add it? Subtract it? Multiply it by year 5 cash flow? What do I do? I'm trying to confuse
You
you.
add it.
Add it. Thank you. what's 178 plus 1586?
193.86.
0.86?
Yeah.
Thank you. And what do I do with that?
You divide it by the 1.47.
Got it. Excellent. And what's 193.86 divided by 1.47?
131.88.
Is everybody getting that?
Yeah.
Awesome. And then what do we do?
You take that number and you add it to the 15.
No, just 1555 divided by 1.36.
Got it. Okay, what's 1555 divided by 1.36?
1143.
1143, then what?
Take 1510,
Got it.
divide that by 1.26.
What's 1510 divided by 1.26?
11.98.
11.98, got it. And then
1452 divided by
1452 divided by 1.17, what do you get?
12.41.
12.41, is that correct?
Yes.
Got it. And then what do we do, last one?
1385 divided by 108.
And what do you get?
13 point.
No, 1282. What? That's wrong.
12.82, got it. Okay, and then add those up, what do we get?
Oh, that's good fact. Holy cow.
What do we get?
$180.52.
80.52, is that what you guys got?
Yeah.
Yep.
All right. Now, obviously, you won't be doing all this stuff by manually doing it in a spreadsheet. And above these, all of these cash flows, right here, these earnings per share, there's an income statement above it, right? And you're gonna get the earnings using the income statement on a projected basis. Then you're gonna divide it by the shares outstanding to get the earnings per share. Okay, so there's another step here. I'm not doing it, but I wanna focus on this so that you get this piece, okay? The spreadsheet stuff you can do. Plus, you've already had it in your financial accounting. All right, so now, the models. Okay. Got it. So we have perpetuity. We got Gordon growth. We got multiple approach. And we got DCI. Got it. And then what were the intrinsic values?
Perpetuity is 173.13.
What was perpetuity?
173.13.
73.03.
Yeah.
And then what was Gordon growth?
197.86.
13, not 03, 13.
Thank you.
Yeah.
And then what do we have for multiple approach?
207.75.
5, got it. And what's DCF? 180, 180.57? 52. So is this one bigger than this one? I'm just checking it. Okay. And then are all these in a relatively tight range?
Yeah.
You don't have like these huge outliers
Yeah.
or anything like that. So that in itself kind of validates itself, which I think is good. And then we're gonna have S1, S2, S3. So we're gonna do 3 scenarios. We're gonna do weighting schemes. We're gonna calculate weighted averages. Is everybody comfortable with calculating weighted averages? Anybody not know what a weighted average I can assume that everybody knows what a weighted average is and they can calculate a weighted average. Yes, no, yes, no, yes, no, yes. Okay. So give me 3 weighting schemes. Which method is the least accurate? Do these large companies like IBM and Intel, would you assume that their earnings are going to grow at a constant rate forever?
No.
Well, maybe not IBM, but Intel has done a pretty good job. Even IBM's been around for what, I don't know, 50, 60 years.
Then you would do Gordon growth.
Yeah, but I'm just saying, which one is probably the least accurate as a methodology in reflecting the true intrinsic value of the firm?
Discounted cash flow.
Perpetuity.
Probably perpetuity, because the assumption is what?
That it's not.
Constant.
Yeah, that the cash flows are gonna remain flat forever, right? And then which other one is fairly simplistic?
Gordon growth?
Huh?
Gordon growth?
Gordon growth is pretty simplistic too, because you're just applying a constant growth rate. Which two are probably the most accurate? Yeah, the multiple and the DCF. And which one is probably relied on more for valuing companies like this, established companies?
DCF.
DCF. Okay. So which one are you going to weight the most? DCF, and what's the second one? Multiple, third, and what's the fourth? So give me some scenarios. Give me 3 scenarios. Now come up with the weighting schemes. And they have to add up to 100.
0.4, 0.3, 2.1.
Are we going this way?
Yeah.
Okay, so you're saying 40%?
Yeah.
Okay, and what was this one?
30%.
30%, and what was this one?
20%.
20%, and what was this one?
10%.
Okay, got it. So what's the second scenario? Again, I'm trying to get you to think, be creative.
Can we just completely eliminate perpetuity? Or is that,
I would give it something because it's pretty close. I mean, if it was really off the mark, I would probably throw it out or give it just a little weight. But since it's really close, it kind of sets a floor to the calculation.
30, 30, 20, 20.
I got 30, 30, 20, and 20. Okay, and then the last one.
You do 10, 10, 40,
50, 45, 5?
Like
15, like this,
30.
10, 10, and then what, you said 40? 40, like that? Okay, so let's do that. So let's start with this one. Let's get rid of these. And let's get rid of this. Okay, well, this is pretty easy, right? So it's 17, 31, got it. And what's 0.2 times 197.86?
Why would it be 17.31?
Excuse me?
Why would it be 17.31? Wouldn't? Oh, I see.
Because it's 10% of the 173.13. These are easy to calculate. And then what's 197.86 times 0.2?
39.57.
39.57, got it. Okay, and what's 207.75 times 0.3?
62.33.
62.33,
Yeah.
got it. And then what is 180.52 times 0.4?
72.1.
72,
21.
thank you. And can you add those up and give me the intrinsic value, the weighted average intrinsic value, or the intrinsic value using this first scenario?
191.42.
191.42, got it. And let's do the next one. Okay. And what is 173.13 times 0.2, where you can just double this, right?
34.62.
34.63.
Great. love the way you guys are talking over each other. It's excellent. Okay, what's 197.86?
We rounded the other one.
Times 0.2, it's gonna be the same. 39.57, got it. This one's the same, 62, 33. Great. And then what is 180.52 times 0.3? What is it? 180.52 times 0.3. 180.52 times 0.3. What do you got?
54.16.
50.16.
Yeah.
Okay, and add those up to give me the intrinsic value under the second scenario.
1969.
19.
069.
69.
Yeah.
Okay. Is that what everybody gets? You should be practicing your weighted average calculations because you're going to need them for the exam, and you're going to for the securities calculations on the exam, and you're going to need them to calculate the peer group financial ratios later on in the semester. Okay. And let's do this one. So we know what this is. Right?
17.31.
Yeah. 1,
19.78.
19.78,
Or 9 maybe.
9,
Yeah, something like
9. Okay. What do you get? How much? 80, 83.1, thank you.
72.21.
72.21, thank you. And then what do we get here?
192.41.
192.41. Is that it? Okay. So what scenario are we going to use to arrive at the final intrinsic value? We need some kind of consensus here. I like when I work with teams. I like to debate and get to consensus where pretty much everybody kind of agrees. Instead of having one person make a decision or two people in the back make a decision for the group, you're just subjecting yourself to groupthink. In that case, and one person should not dominate the decisions for the group.
Depends how much we want to value perpetuity and Gordon growth, because we could do, I mean, we could keep going through scenario after scenario.
Well, most students would pick naively, would pick the value just because it's the highest. You don't pick it because it's high or low. You pick it because the weights are correct. It's the weighting scheme. It's the theoretical. And then you look at the valuations. But you almost don't even look at the valuations. You arrive at the weights first. So what weighting scenario would you like to use for the final intrinsic valuation?
First one.
Okay, I got two firsts.
First.
Yeah,
First,
like
three,
first.
or four, or five, okay, got it. Okay, what you're gonna need to do too is you're gonna need to move this one over and this one over here. Because the one in the middle, when we do this application later in the semester, it's the one in the middle that I'm gonna look to first. And then the other ones are just other scenarios. I'm gonna look to the middle of the PowerPoint presentation, and I'm gonna go right to the middle. Okay? So we're gonna use this one. Okay. So the intrinsic value is how much? 191.42. And then what's the stock price?
157.
15700. Is the intrinsic value greater than or equal to or greater than or less than the?
Greater than the stock price.
Got it. So what's the premium? What's the premium percentage? So just take 191.42 minus 157 divided by 157. We'll give you the percentage change of the premium in which you are forecasting the stock. or the rate in which you think the stock is going to.
0.22.
What is it? 22%? That's pretty realistic. Okay. Could a stock price move 22% in a year?
Yes.
Yeah. Especially a tech company? Yeah. Okay. So that's what I'm looking for right there. So what would be our recommendation? Right off the bat. What would be our recommendation to our client?
Buy at 157.
Yeah, we would buy it. Right? Because we are forecasting the stock price to go up. Okay. And
How much is the premium?
there's two ways of doing it. I could do 191.42 minus 157 divided by 157.0. That's going to give me what? That give me 0.22. That give me 0.22. 100. That'll give me 22%.
Oh, it should be 157, right, on the bottom, not 150.
Yeah.
Oh, yeah.
Okay.
Thank you. So I can do it that way. Or I can calculate it this way. I can take 191.42 divided by 157.00 minus 1 multiplied by 100. It's going to give me the 22%. So I can do it that way too. So here's the secret. This is one way of doing it, right? And you can calculate the percentage from that. You can eyeball it, basically, just as long as you're close enough. This gets pretty easy because that's all you do is divide it. Okay, and it's going to be 1 point something. Right? It's going to be 1.22. Right? So you don't even have to go through these two steps. You know that this is going to be 22%. So a way of doing it really quickly is just to divide the two and then do it in your head. Okay? Unless you like doing it this way. But this is an easier step. That's all I got to do is just divide this by this. And I know this, I know it's 22. So you can get to the answer quicker in your brain than doing it this way. So I always do it this way. But some people like to do it this way. I don't care. You get the same answer. When you're sitting in a meeting and you need to calculate percentages in your head, this is a really cool way. Okay? All right. So trades. Indexes. Is IBM and Intel, does IBM and Intel make up a significant portion of the tech stock indexes based on market cap?
I would assume so.
Yes. So are the pricing, is the pricing that we're forecasting going to be correlated to the overall indexes? If I'm forecasting that IBM and Intel stock is going to go up 22%, do you think there's a correlation between those stock returns and the index returns?
Yes.
Yes. Okay. So can't I, if I do the stock evaluations and come up with a projection of where the returns are going to go, can I also assume that the indexes are going to go up too? Right?
Yes.
Maybe more or less 22% because they're positively correlated? Yeah, absolutely. So if we think that the stock prices and the indexes are going to go up, what would be our index trades that we could recommend to our institutional and our retail clients? What would be the trades? So you've already memorized these because they were on the quiz. And you're using them in your memos. So I'm testing you to see if you memorized them. What would you do?
Buy forward.
Forwards,
Buy futures.
futures,
Buy calls on futures.
buy calls,
And write puts on futures.
and you would write puts. Buy calls, write puts.
Write puts on futures.
On futures. Got it. And how many trades do we have that we could recommend our clients for the indexes based on our
12.
research? No, the indexes.
4.
Okay,
Because it's 3.
logic has changed a little bit from the memos. Okay? So you just have to be careful. So do you think IBM and Intel make up a significant portion of tech stock exchange traded funds?
Yep.
Yes, they do. So there's a correlation between the returns on the stocks and the return on the ETFs, correct? Yes. So what would be our recommendations to our clients in regards to tech stock exchange traded funds?
By a margin.
But first thing I would do is I would recommend that they buy it, because some investors don't want to
Buy
use
demo.
margin.
Okay.
Okay, what would be the next one?
Buy calls.
No, the next one. I have some clients that like to use margin.
Buy a margin.
I own it.
Okay.
Oh, okay.
And then I have some clients that just want to use derivative contracts. So what would be the next ones? Again, it's in your
Right.
exam and it's in your memos.
Buy calls.
Calls.
Buy now.
And what's the other?
Right puts.
Okay, puts.
Okay.
Got it. And how many trades do we have that we can recommend? 4. I can recommend these trades based on our research, not only to our clients, but the proprietary trading units within our firm. We have proprietary trading units, where all of us as partners basically put our bonus money in there. We're compensated, we put money in there, and since you all are so smart in your ability to forecast where these stock prices are going to go, we're going to trade on this account ourselves. We're going to put our own skin in the game because we do a really good job of research. All right, and what about the stocks? The stock. I'm not going to use stocks. I'm going to use stock. But do you think that there's a correlation between, if I can forecast that tech stock prices are going to go up because of earnings per share growth rates in the future, and probably other tech stocks prices are going to go up too? Can I make that assumption too? Yeah, I could. But I'm not going to get into that. I'm just going to do this stock. And what would we recommend for this stock?
Buy.
Buy. What else?
Buy a margin.
Margin. What else?
Buy calls and right puts.
Calls. Puts. Got it. And how many total trades?
4.
I got 4 trades for the stocks, 4, 4, and 4. So I have a total trades. 12. So I have basically 12 ways to make recommendations to my clients. I have 12 trades to advise my clients on. I have 12 trades for a proprietary trading unit to take advantage of. We have 12 trade opportunities. Then what I would do is, if I was teaching an advanced class, securities valuation class, what we would do is test these trades. And of the 12, we may have maybe 3 or 4, maybe 5 of these would actually make sense. And then those would be the ones that we would probably back test a little bit. And then since the meeting is over, at 6 o'clock a.m., we just did this presentation quickly to the managing directors. Starting at 5, we were done by 6, and basically by 5:45. You were at your desk basically placing these trades so that when the market opened, we had already placed our trades, both the derivative trades and the stock trades. Okay? And I'll give you $35 million to place these trades from the proprietary trading unit. And we have discretionary accounts from our clients that want us to trade their money on their behalf, and they've given us discretion to trade on their accounts. Okay? And we're going to do that too. So we could be looking at maybe 100 or 200 million bucks that we could be placing based off of this research. Okay, did you have a question?
How did you come up with the numbers, like the indexes?
4 trades,
Yeah.
4 trades, and then 4 trades, and then I added them up for total trades of 12. So these are just 4 trades. Does that make sense? We're in the memos, we were doing number of indexes by trades. Here we're doing it just number of trades. Does that
So
make
can
sense?
you, it's just automatic?
Yeah, these are 4 trades. These are the 4 trades. I mean, I could have used more indexes times the number of trades. It could have been a lot bigger, just to keep it simple. But you got to remember, it's not the memo approach. This is a different valuation approach. So this, the 4 is the 4 trades, not the number of indexes. Does that make sense? No? No? We're using one index, one high-tech stock index, okay? And we're placing 4 different types of trades based on our research, because we're forecasting that the prices are going to go up. So 1 times 4 is 4.
3 or 5?
Nope, just one index.
No, I mean, you could add 3 stock.
I could add 3 indexes if I wanted to, but for this exercise, it's one high-tech stock index times the 4 trades is 4 trades on the index.
So, how'd you come up with 4? Like, could
4
you
trades.
add 3 trades or 5
4 trades. 1, 2, 3, 4.
But how do you know, how do you come to that?
To these,
Yeah.
these trades, because these are the trades that you would use if you're forecasting the index to go up. These would be the trades that you would use. Okay, which ties right back into your memo, ties back into the exam, and then ties back into the introduction of the derivatives that we had done probably about 3 weeks ago, maybe a month ago. Okay, so these are the trades, the profitable trades that you would execute if you were forecasting the indexes to go up, the high-tech stock indexes to go up. Okay, these are the trades you would use if you were forecasting the high-tech stock exchange-traded fund, the funds to go up based on your research. And then these would be the trades that you would make on the stock, okay, if you thought the stock was going to go up, or other tech stocks that are similar to each other. These are the trades that you would use. Okay. How much time do we have?
1 minute.
Okay, so the last question really doesn't apply. I was just going to ask you if there was any other stocks that you were tracking or recommended, and if you had those stocks, how would you weight them in a portfolio if you were going to construct a high-tech stock index or ETF or portfolio? That's probably just a little bit too advanced for you guys. But I was just trying to get you to think. How would you, after you've done the research, how would you construct a high-tech stock portfolio or an exchange-traded fund or create an index? How would you weight it? Okay? That's all I got. And then next week we'll try to finish the rest of it. And who's presenting next week?
We are.
Okay, cool.
It's like